406. And it's just another one of those classification questions, which I'm going to ask you in the form of multiple choice. So I think the way I did some of those questions was I just said, identify the following as either a current liability, a long-term liability, or not a liability. So like you had three, instead of 4 multiple choice options, just 3. And then I listed the account name. And so there are a few of those like that. Okay. So the following items appear on the balance sheet of a company with a 1-year operating cycle. Identify the proper classification, see if it's current, L if it's long-term, N if it's not a liability. So a note payable due in 13 to 24 months would be what? Long-term. I know some of these are, they're pretty straightforward. But number 2, a note's payable due in 6 to 11 months. Current. Number 3, a note payable that matures in 5 years. Long-term, yeah. In other words, nothing is due for 5 years. It's kind of like your student loan, right? Because you take out the money now, but you don't start paying it back for 4.5 years, right? Current portion of long-term debt. Current. Number 5, a note's payable due in 120 days. Current. Yeah. Now, we didn't talk about FUTA taxes, but a FUTA tax is a federal unemployment tax. And all payroll taxes I mentioned are current. Yeah, FUTA is federal unemployment, if you didn't look that up. Accounts receivable, not a liability. Oh, phew. Glad someone got that right. What is it? It's an asset. Yes, very good. Sales tax payable, current liability. Salaries payable, current. Wages payable. What's the difference between salaries and wages? Typically, yes. Typically, salaries are expressed as an annual amount, like you make $60,000 a year or something like that. And hourly wages, or an hourly rate, is what we really refer to as a wage. So $10 an hour, $11 an hour. Not all the time. A lot of people just kind of pick one term and just use it for, to describe all wages, but that's generally how we like to look at those. Okay, any questions on that first one? No? All right. Let's just get a little bit more practice. So basically what you can expect on the final in Canvas is, for example, I'm going to go through these, but I ask you a question and it's a problem, and you have, instead of you writing out the answer on paper, I give you the answer, the correct answer in one of 4 multiple choice options, right? So only one's right, the other 3 aren't right. But you need to bring, well, I have paper, but you need scrap paper, calculators, and a pencil so that you guys can work those problems out on paper, okay? All right, so prepare any necessary adjusting entries at December 31st for Piper Company's year-end financial statements for each of the following separate transactions and events. So this is a little bit of everything, but Piper Company records a year-end entry for $10,000 of previously unrecorded cash sales, costing $5,000, and its sales tax rate is 4%. So basically, we're recording a cash sale for goods that cost Piper Company $5,000, right? So, all right, and these are all year-end, so this is December 31st. Okay, so on December 31st, we're going to debit. Who wants to tell me what we're debiting? We're recording cash sales, so what do I debit? Cash. Right? I'll come back to that amount because I'm going to credit 2 other accounts. What are they? Sales or sales revenue? Sure, either one. You could just say sales if you want, or sales revenue. And what am I collecting? We had examples of this. Yeah. Okay, so what's the total sales revenue? 10,000. That's what we charge the customer, right? Plus the 5% sales, or I'm sorry, 4% sales tax. So we're going to collect another 4% on the 10,000, which is So how much cash would I be collecting? Yeah, you guys better know how to do this. I've done a couple of these now. I also need a second entry. That second entry allows me to record my costs associated with this merchandise. Remember, I gotta buy shoes to put in my store before I can sell the shoes, right? And so I want to record the cost of my merchandise and remove it from my inventory. So we also need an entry to debit cost of goods sold and credit merchandise inventory for the amount of $5,000. Remember, every time we sell something, every time we sell merchandise, we have two entries. One to record the revenue, and now our revenue includes sales tax, right? Or not our revenue, our transaction includes sales tax. And then the second entry to remove the item from inventory. Okay? Gotta know how to do that. Final. And then number 2, the company earned $50,000 of $125,000 previously received in advance and originally recorded as unearned service revenue. So what they're asking us to do is the December 31st entry, right? So I'm going to put that here. But let's talk about what would have been previously recorded at a prior date, because that helps me get to this. So what does it say that they received? So that would be cash, right? So we'll debit cash. This is not the answer. It's just going to help me get to the answer. And it says the receipt of that cash was originally recorded as unearned service revenue, which is what kind of an account? Liability. So between that date and December 31st, some of that unearned revenue is what? Earned. So I got to get it out of, I want to remove it from the liability account on December 31st by debiting the account. And where am I going to move it to? What kind of account? If it's no longer unearned, then it must be earned. So we'll just call it service revenue. And how much? 50,000. Questions on that second one then? Smell the burgers. Smell the burgers. All right, 9.3. Now I know I have 9.4 highlighted. I think I said we might do it, we might not do it. But this is similar to one of the quick study problems that we did, where we had to split the interest. Do you remember that? Okay. So we did one of those already. We can do another one if we want to practice. If not, that's okay too. But 9.3 is a little simpler version of the notes payable problem. So let's see. Sylvester Systems borrows $110,000 cash on May 15th by signing a 60-day 12% note. So it says, on what date does this note mature? So remember, first thing you got to do is figure that out. And again, you could pull up the calendar and count 60 days. Or if you know exactly how many months are in how many days are in each month, you could do a quick math there. But we'll do it the long way here. So how many days are in May? So if this was signed on May 15th, right, 31 minus 15 is? So we got 16 days remaining in May, right? All right, so that gives me, right? Okay. What comes after May? How many days are in June? My due date, right? Got it? Let's see, then it says, suppose the face value of the note is $110,000, the principal of the loan, prepare the journal entries to record the issuance and the payment. All right. All right, so the issuance would take place on May 15th, right? So what is Sylvester Systems getting? Cash, yeah. So they're going to debit cash, or 110,000. And what is that liability account we'll use? Notes payable. Remember, notes are loans. Marker's running out of juice. Try another one, I guess. So when they pay back the note, what else do they pay along with it? Interest. And we just figured out July, this isn't much better, July 14th, right, is what we call the maturity date, right? This is the maturity date. Oh, there we go. And when the note matures, that means we pay back both principal, the amount that we originally borrowed, plus interest on the date that the loan matures. So if I were to put this in a T account, that would have been a credit, right, a liability. So how do I satisfy, or what do I do to the liability to clear it out? I debit it, because that's what I'm doing on July 14th. I'm paying it back, right? So I'm going to debit notes payable for the amount I'm repaying, which is all of it. What else do I have to figure out on this date? Interest. So I'm going to debit interest expense. I only use interest payable when the end of the year interrupts my maturity period, my loan period. Then I have to do an adjusting entry at December 31st. But for now, I don't have to, oh, I said interest expense and I wrote interest payable. Oh my goodness. My brain. I don't even remember writing payable now that I say it out loud. Oh, and I'm going to credit what? Cash. Okay, but let's figure out what the interest is. Okay. How do I figure it out? P times R times T, right? So the principal of this note is 110,000. The interest rate that the bank is charging, 12%, and the time period for which we're going to have the use of the funds. There we go. Remember, this 12% is an annual rate. In other words, assuming that I have the money for a whole year, I'd pay 12% interest. I wouldn't need this. But I only have the money for 2 months, so I don't want to pay 12%, right? I only want to pay a fraction of 12%, equal to the time I actually had the use of the funds. So when we do all that math, what do we get? 2,200? Okay. So in addition to the principal of 110,000, I got to also pay interest of 2,200. So I credit cash for 112,200. Okay. Questions? Now this next one, number 4, I want to put you up here. Look. I don't know if you've noticed these before. I don't know why I waited this long to tell you, but sometimes there's little check figures in the margin, right? So interest expense 2,200, obviously that matches, right? So if you want to attempt this next one on your own, because we did one on Wednesday, or Monday, I mean, today's Wednesday, it gives you, it splits up the interest for you December 31st and then on the date that the note is due. So you have some check figures there if you want to try one of those again. But you do have a quick study problem. as a reference. But that's just, again, if you want a little bit of reinforcement there. There is one other question I want to look at with you guys, and that deals with, where is it? Oh, contingencies. So the other day we talked about contingencies, and we talked about a variety of examples of contingencies. So I'm on page 406 again, and this is just quick study 9-10, and really no calculating here. We just talk about our options for contingencies. So remember, based on our little chart, there were two criteria for determining whether you had to record a contingency or whether you had to disclose it in the notes and the financial statements or do nothing, right? So the first criteria was the likelihood that it would happen. Remember that? You guys remember that chart? And then we had to figure out, if it's likely to happen, can we estimate an amount? Those two things, it has to be probable and estimable, right? You have to be able to do both before you can actually create a journal entry. If it's probable, but you can't estimate it, then you can't do a journal entry. You just have to talk about it. You have to give a narrative in the notes of the financial statements so that the users of the financial statements can read about it, right? This lawsuit might be coming up, just making you aware, that kind of a thing. If none of those things apply, or if it's remote, then you don't have to do anything, right? Because, as I mentioned the other day, businesses get sued all the time. It's not necessarily a bad thing. All right, so we have Hugh Prey Company is the defendant in the following legal claims. For each of the claims, we have to say they record as a liability, disclose in the notes, and the word disclose means to tell, right? So in the notes to the financial statements, do we have to tell about it? And I'm going to show you some notes here that are in your book, just so you have an idea what it looks like. And then, or C, have no disclosure. In other words, you can just kind of ignore it, right? Number one, Hugh Prey can reasonably estimate that a pending lawsuit will result in damages of $1,250,000. It is probable that they will lose the case. So do they have to journalize that? They do, yes. So they have to record that as a liability. So it's a debit to a loss of some sort, account, and a credit to a liability account, lawsuit liability, something like that. But and that'll impact the balance sheet and the income statement, right? So if you can estimate it, you got to get it on there. Number two, it's reasonably possible that Hugh Prey will lose a pending lawsuit. The loss cannot be estimated. What should they do? Just disclose it, because reasonably possible is 50-50, right? You have to disclose that. So, yes, number two is B. Kind of gave us, obviously, an example of all of them. Hugh Prey is being sued for $2 million damages, but it's remote. It's unlikely that they will lose the case. Don't have to do anything. No disclosure. Even though there's an amount there, I mean, people can say what they want. I'm going to sue you for $5 million, right? If there is no case, it doesn't matter how much they say they're going to sue you for. So I wanted to make sure we covered that. The only other thing I wanted to show you, and we talked about financial statements all year long. For the sake of time, I don't actually have a lot of time to kind of show you guys what real life financial statements and such look like, but there is an example in your book, and it's Apple, okay? So and this is an appendix, and the only reason I'm showing this to you is just so that you have some idea of what such financial statements might look like. So Apple is a very large company, I'm sure, as you all know, right? And you can see there that that says consolidated balance sheets. So that is the most summarized version of their balance sheet that is possible, right? And they've got that's all assets at the top, right? So there's some of the assets that we looked at. So these are real life financial statements, right? Always do them for 2 years on the balance sheet. Usually the income statement is 3 years, but here we have cash and cash equivalents. We never talked about short-term marketable securities. Those are investments. Accounts receivable, look, less allowances, right? Inventory. We didn't talk about non-trade receivables, but other current assets. Then we have property, plant, and equipment. There's goodwill. There's other intangibles. So at least you get to see what, some of the things we've talked about, there they are on a real financial statement, right? And as you scroll down, there's the liabilities, and they call it shareholders' equity. We call it just equity, same difference, right? Stockholders' equity, another word we could use. But there's accounts payable and accrued expenses. Deferred revenue is the same as unearned revenue. Just another word that means the same thing as unearned, right? Commercial paper, didn't get into that. Those are short-term loans that companies make between each other. Current portion of long-term debt. Look, we just got done talking about that, right? And then we have the long-term debt section, which we haven't, that's chapter 10. Those are just more longer-term loans and such investments. And then you have shareholders' equity and retained earnings down below. So again, we've talked about all those things, but this is actually seeing them on a real financial statement. The income statement can get a little bit more complex. Over here, and this is in the appendix if you have a book. Not a big deal if you don't. You can go online and look at any publicly traded company's financial statements. You can Google it. Lots of places you can find them. But here we have 3 years, right? And that's to identify, oh, for heaven's sake, there we go. That's to identify trends in income over periods of time. So there's net sales, right, at the top, right? Cost of sales is the same as cost of goods sold, okay? And then operating expenses, operating income, and a lot of things we didn't get to in this class and not supposed to get to, but we have income taxes and things like that. But generally speaking, most of what at least it should sound familiar to you, right, from the financial statements we looked at. And then this is a little different. Comprehensive income is pretty complicated. I won't get into that. Shareholders' equity. Remember how small our shareholders' equity statement was? This one's a lot more complex, right? But anyway, these are what financial statements look like. So they span 4 pages, right? Apple's financial statements, all consolidated, in other words, very summarized. And on the opposite page is the statement of cash flows, which we did not cover in this class. But it identifies how much cash Apple has to work with in these years. Again, that's pretty complex. That's why I don't cover it in this class. But 4 pages in there, you have your financial statements. What follows the financial statements are those notes. So when we talk about disclosing or telling about something, this narrative, and I'm not going to obviously stand up here and read any of this to you, but the narrative, for example, Walmart's narrative is, Walmart's 10K, which is basically the financial statements in the narrative, is 180 pages long. So if you think about providing detailed explanations about a lot of the items that you just saw in those financial statements, this goes on for pages, right? Look, these are what we refer to as the notes, and there are additional schedules. So you might see schedules that were too big or other reports that didn't fit in any of the financial statements. You might see the details of those here. But these accompany the notes, right? That's another chapter or another, but so they're lengthy. So that's where you would find information about contingencies. Like, for example, let's see if I can find the contingencies in here. I don't know if there are any, to be honest. I didn't. Might not have mentioned them here. No, so this isn't the full version of the notes. So I just off the top of my head, I don't see them. But anyway, actually there's a section on warranty costs. Warranties are technically a contingency, so there's those. I was looking more for lawsuits, but anyway. So that's what the notes to the financial statements are. They're just a narrative that provides detailed explanations about the, yes, Gabby.
So if you were like a small business owner,
Mm-hmm.
would you be doing all this, or would you usually like hire?
Well, it depends what kind of business your company organized your company as. So this is for publicly traded companies, so that if you're an investor, you have as much information as possible to make a decision as to whether or not you want to invest your money in this company. So a store that's like a little business that's not publicly traded, maybe privately owned, owned by family, something like that, would not have to produce this. So yeah, this is for publicly traded companies. And there are guidelines and rules that you follow for how you actually produce these kinds of, and you most likely have an accountant that does all that for you. So yeah. Auditors will help out with this type of thing. Public accounting firm that you hire, whatever. And you might have an internal accountant, but who would do maybe some of this, but yeah, they're very, some of them are very lengthy. Like I said, if you pull up Walmart's, it's like 180 pages long. So there's a lot that goes into it. It's like a book, like I think I described before. Maybe I didn't describe it that way to you guys, but You have to think of the financial statements, the collective group of all the information as a book, right? And what's inside a book? Chapters, right? And within those chapters are paragraphs. So I look at it this way. The balance sheet, the income statement, by themselves, right? A balance sheet by itself, an income statement by itself is one paragraph of a chapter. Maybe all the financial statements together are one chapter of the whole book. But then the notes to the financial statements are multiple or additional chapters, and collectively they make up a book, right? They tell the whole story. So it's a lot more than what we obviously can cover in this class. But anyway, exam. So here's, I wanted to tell you guys. There are 20, when you look at the exam in Canvas, what's going to happen, there's going to be 25 questions. One question is the classification. There's 20 points within that, but it's all one question within Canvas, the way I have it set up in the quiz. So it'll be 3 columns, well actually 4 columns, because the first column will name the account. So for example, cash, the first column, you'll hit the drop-down list, and it'll say asset, liability, equity, revenue, expense. You pick asset if it's cash, right? You move over to the next column, drop down, normal balance, debit or credit. Pick debit, right? And then over to the far right is on which financial statement will you find cash. Look at your drop-down, income statement, statement of retained earnings, balance sheet. So you pick balance sheet. When it grades it, it's designed, the whole thing's worth 20 points. So it'll give you partial credit. Like let's say you got the first 2 columns right of that, but you didn't get the last column right. It'll give you partial credit, okay? Then there are 24 multiple choice questions, but they're worth, so the classification problem's worth 20 points. The multiple choice are worth 30 points. Even though there are only 24 multiple choice, some of them are worth 2 points each because they involved calculations like interest or something like that. All right, so I did weigh those a little heavier than just, a definition in a multiple choice question. All right, so scrap paper, which I always bring, pencils, I always bring those too, and calculators, always bring those. That's pretty much it. You guys have any questions? Yes, ma'am.
We're coming in class, right?
In class, in this room, 10-10, right? Okay. Good luck with the rest of your finals. Go get a burger if you didn't get one. They're making me hungry. The smell's making me hungry. Sure. Actually, let me grab my glasses first.